What's going on? I'm Tony with Real Life Trading, and if there's one thing in the stock market world that I think brings fear and confusion and intimidation more than anything else, it's this word, options. Options confuse the heck out of people. They make people worried, nervous, and yet they're the one thing that everyone wants to trade because that's where the money is at, and there is some amazing money to be had in options. Today in this video, let's spend a few minutes just easing some of those fears. Let's teach you what options are, how to use them, how to trade them, the do's, the don'ts, what to stay away from, what to do, so that you can have a clear understanding of how you can apply them in your trading strategies to make some serious returns. Let's dive right into this. All right, so what in the heck are options? Well, you have two types. You have calls, okay, and you have puts. Let's start with calls. What are calls? Easiest example to figure out what calls are. If you are purchasing a house, okay, this is a $300,000 house, $300,000. And you put some earnest money behind this, okay? So in order to buy this $300,000 house, you put $5,000 down. And that $5,000 allows you to control this asset, this $300,000 house, for a duration of, let's say, 1 month, okay? So you've got 1 month controlling this $300,000 asset. For a month, no one else can buy it. You buy it, right? You can either go through with the purchase and buy it for $300,000. That's the agreed price. That's not going to change during this contract, right? Or you can walk away, but you'll lose your $5,000. All right? So again, you're buying this house, and across the street from this house, there is an empty lot. Okay? There are two scenarios that are going to play out over the next week. Either they're going to be building a nasty waste facility that's just stinky and disgusting, and this house value is going to tank by 50 grand. Okay? And you're already under contract to buy it for 300,000. Or they're going to build this beautiful park, and it's going to be awesome and happy, and that's going to make the value of this house jump up 50 grand. Okay? So you've either got $350,000 house in front of you or a $250,000 house in front of you. So let's say scenario number one plays out, and they decide to build that waste transfer facility across the street. So immediately you have to buy the house for $300,000. If you go through this, immediately you're down 50 grand. You can then decide to go, you know what? I would rather lose the $5,000 earnest money and walk away and not be underwater $50,000 to start, or buy the house and just be underwater 50 grand. Okay. Scenario number two happens. They build the park. You've immediately got $350,000 now. Like, sweet, I got 50 grand of equity in this house right away. You could go ahead and buy this house now, right, for $300,000. Or you could go to someone else and go, hey, who wants to pay me $15,000 to have my contract to purchase this $350,000 house for $300,000? So you flip it to someone else. You never even buy the house, and yet you just made 10 grand, right? So calls are the exact same way, okay? Calls are an agreement, all right, do a little more art. It's an agreement to buy a stock at a certain price within a certain time period, all right? So let's say you have the stock, it's ABC, whatever, trading at $100, and you buy the 110 strike call. Each contract that you buy, it's for 100 shares, okay? You are in a contract to buy this stock at $110. Now you paid $1,000 for these calls. Okay, that is your earnest money, so to say, in this scenario. Scenario number one, stock market goes down. It goes down to 90 bucks. Okay? Down to 90 bucks. You own a contract to buy this at 110. You can fulfill that contract, but you're immediately going to be underwater. Or you can walk away and you'll lose your $1,000 earnest money. Okay? What if the price of the stock goes up? What if it goes up to $120 during the month that you own this contract? Well, you can exercise this contract and buy the stock at $110 like your contract states, even though it's at $120. Or you could flip it to someone else. So you paid $1,000 for this and you say, hey, who wants to pay me $2 grand to own a contract to buy this stock at $110, even though it's at $120? That's what a call is. Okay? Does that start to make a little bit more sense? So what is a put? A put is insurance on the markets. You know, you can buy insurance on the stock market. So let's say you bought Apple at $25 back in the day here. Okay, 25 bucks. That's really bad. You get it. 25 bucks. Apple's currently sitting, let's say, at $200 or something. Okay. And the stock starts to tank. What's your only option? Well, most people think their only option is to sell it. Cool. You just made tons of money. You're a trillionaire. But where do you buy back in? You buy it at 150 bucks. Well, now your dollar cost average is 150. When you bought it at 25, you never want to sell it, right? Instead of selling, what you could do is you could buy puts. You could buy one put for every 100 shares that you own of the stock. As the stock tanks, those puts will gain value, and it's going to offset the dollar value that you have lost in your shares. So then you can go ahead and just cash out those puts, cash out that insurance, and you're going to make whatever coverage your shares have lost. And that way you're still in the shares, but you never lost any money. Or you can go ahead and exercise that put and go, you know what? I'm going to go ahead and sell my shares at whatever strike price you bought. So if the current price is at $200 and you bought the $170 strike puts, you're insured from 170 down to 0. Okay. But anything above 170, your insurance doesn't kick in. So if the stock drops to 190, the insurance is just worthless. So if you spent $1,000 on puts on this insurance and the price goes to 175, your insurance is invalid. It's only valid below 170. Okay, whatever strike price you buy. If you bought the $200 strike puts, then it's going to cost you more. You're probably going to pay more, like $3,000 in that situation. But you are covered from 200 right where the price is down, right? Or you could buy insurance at $150. Even though the price is at 200, and that's going to cost you, let's say $500 cheaper, right? Because you are now having $50 on the line of that's not insured, and then you're insured as soon as it gets below 150, you're insured now. It's going to cover that cost. Does that make sense of what puts are? So that's what the difference of calls and puts are. What's the purpose of all of these things? Well, kind of went over those things, right? If you want to purchase something, and you might not have the cash for it yet, you could buy some calls. And that way you're under contract to purchase the stock, and you could always back out. And now, of course, you'll need the cash to purchase it, right? A put, we just went over that definition of exactly how a put would be used. So how can you use these things, right? What if you're like, Tony, I don't want to buy the stock. Tony, I don't own any Apple stock. That's where we can flip these options. And 95%, 98% of the options out in the world, people are flipping, okay? So Apple's up at $200. You don't own any stock. But let's say you buy the 190 strike puts. You don't need to own the stock to buy puts. You can flip it. And if Apple does tank down, then you can sell that put to someone else and hopefully do it for a profit. If Apple never tanks, you could sell that put to someone else for a loss or just let it completely expire. Okay. Same thing with a call, like we explained earlier. You can buy some calls. If the price goes up, you can turn and flip that call to someone else. You're owning something that's valuable. If the stock market just decides to go lower, there's no value to that call, and you're going to sell it to someone else for cheaper than what you bought it for, which means you lost money, or it just evaporates and goes to 0. Okay, so that's the first little lead in now of what do you not want to do with options. The biggest mistakes people make with options are they buy way too far out of the money. So if the current stock's at $100 and they buy the 150 strike call, why would they do that? Why out of the money? Because it's cheap. It doesn't cost anything, right? It's cheap. They're going to spend $200 on those calls. And it's like, I could buy the 110 strike call, but that's going to cost me $1,000. I'd much rather just spend a couple $100 on this and have it way out of the money. Well, remember, you are buying a contract that's stating that you're buying this at $150. So if the stock goes up and it goes all the way up to $140 and then it pulls back down to $135 and your option expires, you ran out of time, right? Because there's a time period with each option. Your $200 is worth nothing. Who's going to buy your contract from you to buy the stock at $150 when they can just go to the market and buy it at $135? No one's going to buy that from you. So is there any value in that? There's no value in that. So your option goes to 0. Let's take this exact same scenario and say you bought the 110 strike calls. Well, the price ended at $135. There is value to that. You can go to the market out there, the option market, and go, hey, I own a contract that allows you to buy this stock at 110 bucks. It's currently at 135. Who wants it? And you'll get paid for that. You see the difference? If you go too far out of the money, even though you're correct on the stock price movement, you'll still lose your money, because it's all about the value and probability of, is it going to be above your strike price by expiration? My friends, you do not want to be buying strikes way out of the money. I would say don't go any more out of the money than 35 delta starting out. Okay, I'll show you what that is in a little bit. You can look that up. Trying to keep this video as short as I can, but stick to that rule. Your broker will show you what the 35 delta is. Buy that strike. Don't buy anything further out. Don't fall into the trap of buying too far out of the money, or else it's going to be very, very hard to ever make anything. The cheaper the route when buying options, usually the worse play it is. The lesser probability you'll actually make any money on it. The second mistake people make is they go too soon on the expiration. Okay. So again, let's say the stock's at 100 bucks. Your target on this is $120. And you're like, man, I really think it's going to get to 120 bucks. This stock moves $1 a day. Okay? The average range of this stock is $1 a day, let's say. If you bought the 120 strike calls and you bought an expiration on these options that expire in 10 days, what are the probabilities it's going to get to 120 in 10 days? Well, if it only moves $1 a day on average, you could be perfect and it goes straight up, and you're still going to fall short and not make money by expiration. Now, if you get out beforehand, you're good. But mathematically, there's a reason why that option is cheap, because mathematically it's got a 1% chance that it's going to go out, double its expected move over the next 10 days. It might do it for one day, but it's not likely. There's a reason why that option is dirt cheap, because it's a low probability chance of happening. Realistically, if you think it wants to go to 120, you want to triple the amount of time you think it needs. So in this case, you would need to go at least 20 days out. But that's 20 days granted that there are no pullbacks. The markets are going to pull back. It's going to move in a wave like this, right? Teach that in the price action S-curve course. Look that up. You got to understand how these markets move in order to be successful. So that means you might spend 1 or 2 days pulling down here and a couple days pulling down here. Even though you're correct, you're still going to fall short. So if you bought this 60 days out, is it going to be more expensive? Yes. But it's giving you a high likelihood that the stock will actually have enough time to go to your target and be valuable, be worth something close to expiration where someone might actually want to buy that from you, right? If you spent on $1 on this option, remember you got to times everything by 100. So if the call cost $1, it's really going to cost you 100 bucks. And that was when the stock was at 100. If it goes all the way up to 120, that option is now probably going to be worth $3, $4. Who knows? Maybe more. So now you turn that $100 investment into a $400 value, and you can sell that on the market, on the option market, to someone else for $4, even though you spent $1 on it. So that's how you're able to utilize it. And those are some of the key mistakes people make when it comes to options. They go too far out of the money and they don't give themselves enough time. So go closer to the money, go closer where the current price is. That's true for calls and puts, and give yourself 3 times the amount of time you think you need. Now, you can dial that in. I'm just saying this is a good kind of first step whenever you're first learning options. Be safer. Spend the more money on options, but realize there is a chance they can still go to zero. That option can still be worthless. If you spent $1,000 on these calls, you're like, well, I spent so much money, there's no way I can lose. No. If the stock market goes down on these calls, your value is going to go lower too. Which brings me to my last point here on what not to do. If you're buying to flip options, you need to be in that option for about 30 to 40% of the time that it has left. If you buy an option that expires in 10 days, it better hit its goal in 4 days. If not, get the heck out. Because every day that goes by, the probability that it's actually going to get to where it's profitable gets lower and lower. That's one of the easiest way of thinking about it. Realistically, it's theta. It's time decay. Time is not on your side, because every day that goes by, the probability that it has enough time to get to where you want it to go to is reducing, right? A stock can move $100 in 3 years, but it's very hard for a stock to move $100 in 2 days. Does that make sense? It's the probability of something happening The more time it has, the higher probability it can make that move. So you want to give yourself more time, and the idea is don't hold it for that entire allotment because you are losing value every single day. The probability technically gets lower and lower and lower that it's going to do what you want it to do. Buy more time, hit that target, and get out quick. This comes to buying options, okay? So now let's look at, what does this even look like on your broker? Let's pull this thing up here. You're going to see a chart that looks like this on your broker, okay? And you're going to see these expirations. Okay, you can choose an expiration. It's going to give you a drop-down list. These on the inside are strikes. These are what you're buying, right? On this side over here are calls. On this side over here are puts. So there is a 377 strike put, and there is a 377 strike call, right? Calls gain value as the price goes up. Puts gain value as the price of the stock goes down, right? Simple as that. So you can choose your strike. Right over here is your delta. So remember what I said, buy the 35 delta. So in this case, if you wanted to buy puts, you'd be on this side of the chart. Okay, this is like your middle ground, your fence. This is puts on this side, calls on that side. Choose your expiration. And by the way, every expiration looks exactly the same on this. There is a 377 strike put that expires September 13th. And there's also a 377 strike put that expires September 14th. Again, the more time you need, the safer. But there's also a balance of, if you think the move's going to happen in 2 days, you don't need to buy a year, right? You're buying overkill. It's not going to make as much money. So you want to kind of balance that, but give yourself more time starting out with options. So find your 35 delta. That would lead you to 373 strike put right there. Over here, your 35 delta is going to be moving down because out of the money, right, on the calls, which means the price, the lower we go on this chart, the higher the price is getting. This is also the price of the stock, right? So your 35 delta is going to be right in between 382 and 383. That's how you choose what strike you want to buy. So hopefully this kind of helps you a little bit to manage what options to buy, how they work, what the purpose is of it. You're basically just flipping something. You are trying to buy an asset where, you know, instead of buying $300,000 worth of shares, you could spend $1,000 and control that same amount. And if the price, you know, goes up on if the price goes up on the stock and you own calls for $1,000, you can then sell it to someone else for a higher value than what you sold it for. So if you sell it to someone else for $1,500, you just made $500. See how that works? So it allows you to use a very small account to control a large amount of money and make a really good return. A lot of people are like, I don't have $300,000 to buy a house. It's like, well, if you paid $5,000 to enter into a contract knowing that you could sell it to someone else for $6,000 for that same contract, you never have to buy the house, and yet you just made $1,000. That's what the option market is. Now, there also are purposes when you do own the shares with options, but most of the time you're not going to do that, right? That's for a different video. This is just how do you make money buying options? This is the simplest way to understand it, the simplest way to go about it. How do you control your risk? The simplest way to control your risk, my friends, when it comes to options, because I would say the majority of fear comes from like, what if I lose? Like, what if I lose everything? Whatever you spend whenever you buy options, that's the most you can lose. So if you're comfortable to lose $100, if you spent $100 on calls, what's the worst thing that can happen? You lose $100, which is exactly what you were comfortable to do. So it's actually much easier to control your risk. Because if you, let's say you buy the stocks here at $100, same example, you buy some calls and it goes up, and then overnight the thing just gaps down 20%. Guess what's going to happen? You are going to lose $100. If you spent $100 on calls, you'll lose $100. If the stock gaps down 40%, how much are you going to lose? $100. It's really easy to control your risk, and that's why I love to do my swing trades with options, because then I can sleep at night. Now, again, this is just beginners. This is the easiest way to go about it. What most people do with options, they're comfortable to lose $100, and so they spend $2,000 on calls. There's a chance you could be losing your $2,000 if you're not correct, or if it takes too long to be correct, or if you bought an option too far out of the money and you are correct, but it didn't go far enough in order to make money. Put the size on, buy the option size that you are okay to risk starting out until you get an idea of how the options move, because there are a lot of things that affect the option prices. That's for another video. But this is at least going to give you some do's and some don'ts so that you can be a little bit more confident in trading options, that it can give you a little bit more of a foundation and something not to be scared of. In fact, options are easier than shares, in my opinion. Buy the 35 delta, buy 3 times the amount of time you think you need. If the move you think is going to happen in 5 days, buy it 15 days out. Buy the 35 delta, spend the amount of money that you are okay to lose, and then you don't even need to stop, because you can just let it go. How many times do you get into a trade and it comes down, stops you out, and then goes all the way to your target? Frequently, right? There are lots of really cool ways that you can manipulate options to help you in your strategies, to help manage your risk, and to help you to sleep better at night and be a little bit more successful with a very small trading account. I hope this video has helped you give it a little bit of a foundation. There's a lot more to it, but at least take away a little bit of the fear and give you a framework and a structure so that you can be successful when you're buying options. Don't fall for the easy money and the cheap stuff. Put the size on that you're okay to have, buy closer to the money, give yourself more time, and enjoy flipping these options, because it is one of the best ways to make money in the markets. That's it for me. Again, Tony with Real Life Trading. Thanks for your time. Follow us, come join with us, come trade options with me. I do it every single day, flipping options. And if you want to learn how to sell options, I've got a credit spread course, crushing it. Find it on reallifetrading.com. Email me, tony@reallifetrading.com. Reach out to support@reallifetrading.com. Come check us out in a free trial. Come trade alongside of us every single day. We'll show you how to trade these options. Start making some money. Invest that back into some more coaching so that we can teach you how to make more money. Invest that back, and then before you know it, you're making a pretty consistent income, because that is the goal here. If you like this video and you want to see more of this video, hit that like button. Subscribe to us here at Real Life Trading. We've got a lot more stuff coming. Leave a comment to let me know what questions you have on options, what videos you want me to do next, and I'll start bringing them out for you. See you guys.